Okay, welcome to the deep dive. We've got, well, quite a stack of guides and checklists here, and even some thinking on the philosophy of wealth, all pointing towards that huge step, buying a house.
That's right. We're really digging into sources that cover, everything from getting your finances in order right through to signing on the dotted line.
Yeah.
Our mission today is to pull out the really essential stuff, the practical tips, maybe some hidden gems, so you can navigate this whole thing feeling, well, informed, not totally overwhelmed.
So what are we getting into? We'll look at getting your financial ducks in a row before you even think about looking at houses. Why that inspection is so critical.
Absolutely.
Finding the right people to help you, and what actually happens when you finally get those keys.
And we'll even connect it back to this bigger picture of financial freedom using some interesting thoughts from one of the sources.
All right, let's just jump right in then. The sources all agree. Buying a home, probably the single biggest purchase you'll ever make. So what's the very first thing they say you have to do, like before even talking to a bank?
You've got to do your own financial checkup, kind of like getting yourself ready for the questions the banks are going to ask.
Okay, a pre-checkup. What key things does that involve?
Several really crucial areas. First up, your income.
Mm.
Lenders, they need to see it's not just there, but it's regular, consistent.
Right.
They need that confidence you can actually make the payments every month.
Makes total sense. And then, the big one, credit score and reports.
Yeah.
What's the emphasis there in the sources?
Oh, hugely important. Lenders lean really heavily on your credit history and score. That decides, if you qualify and what kind of terms you'll get.
Mm-hmm.
So a key tip is get your free reports. Experian, Equifax, TransUnion. The place for that is annualcreditreport.com.
Right, I've heard of that. And those scores, they vary a lot, don't they? What's the typical range, and what do the sources say is good versus maybe difficult?
Yeah, they go from 300 all the way up to 850. The sources generally say scores over 760. That's where you'll typically find the absolute best terms.
Yeah.
If you're under 500, it starts getting really difficult to get approved for a mortgage.
And are there different bars depending on the type of loan you're after?
Oh, yeah, definitely. For a conventional loan, you often need at least a 620 score, give or take. But if you're looking at government-backed options like FHA or VA loans, they can be a bit more flexible.
How flexible?
Well, an FHA loan, for example, might go down to 580 with most lenders, sometimes even 500 if you can put down 10%.
Wow.
And VA loans for veterans are often really lenient on credit scores.
That's interesting. So there is a path, even if your credit isn't, perfect. But what's the catch? What's the trade-off if you buy with less than great credit?
You should definitely expect to pay higher interest rates. And that means, well, bigger monthly payments, significantly bigger sometimes.
Okay.
Now, the sources do point out that refinancing later, maybe after your credit improves, is an option to potentially get a better rate down the line.
And does having more cash for the down payment help if the score is low?
Oh, absolutely. A larger down payment can definitely help offset a lower credit score. It reduces the lender's risk, you see.
Right. So, okay, someone does this financial checkup, realizes their credit needs some work. What specific tips do the sources give for boosting that score?
A few really solid ones. First, focus on paying down your existing debts. That's key.
Uh-huh.
Use credit cards, but use them responsibly. Like pay the balance off in full every single month. And always check your credit reports for mistakes. You'd be surprised how often errors pop up.
Yeah, I've heard that. Are there any maybe less obvious tricks or strategies?
Well, the sources mention a couple of interesting things. You could try asking for credit limit increases on existing cards. That can help your utilization ratio. And it's usually just a soft pull, so it doesn't hurt your score much.
Okay.
And maybe adding some new accounts, potentially a few around the same time, can help diversify your credit mix and build history.
What about nasty stuff like collections? If that shows up on your report, that sounds bad.
Collections are definitely viewed negatively, yeah. But the sources mention a pretty powerful tactic. Try negotiating a pay for delete.
Pay for delete.
Yeah, you basically offer to pay the collection amount if they agree, in writing, to completely remove the negative entry from your credit report afterwards. Getting that agreement in writing first is absolutely crucial, though.
Wow, okay, that's a really useful tip. Anything you should definitely avoid doing right before applying.
Yeah, try to minimize hard credit inquiries. When lenders pull your full report, especially right before you apply for the mortgage itself, those inquiries can ding your score a bit, and they stick around for about a year.
Got it. So beyond credit, what other money stuff are lenders digging into?
Your existing debts. And specifically, how those debts stack up against your income. That's your debt to income ratio, or DTI.
DTI. How's that calculated, and what are the numbers lenders like to see?
It's pretty simple, actually. It's just your total monthly debt payments. Think student loans, car payments, credit card minimums divided by your regular gross monthly income.
Correct.
If that percentage is much higher than, say, 40%, getting a loan gets really tough. The sources suggest aiming lower, maybe more like the 20% range if possible. That gives you way more breathing room.
Right, more flexibility. Okay, so income consistency, credit health, managing existing debt. What's the last piece of this financial prep puzzle?
Cash. Having savings and cash ready to go. And this isn't just for the down payment, though. That's a big part. Lenders usually look for anywhere from 3% to 20% down.
Uh-huh.
It's also for all the other costs that come up, especially the closing costs.
Ah, yes, the closing costs. We'll get to those. But setting the budget isn't only about the upfront cash, right? It's really about that ongoing monthly payment.
Absolutely. You need to figure out realistically how much house you can afford every single month. The sources break this down nicely with PITI,
PITI.
principal, interest, property taxes, and homeowners insurance. That's the core monthly housing costs.
And like you said, if you put down less than 20%, you often have PMI, private mortgage insurance, tacked on to that PITI payment too.
Correct. Plus, you've got to factor in potential HOA fees, homeowners association fees, if the property is part of one.
Right.
The sources really recommend using online affordability calculators. Play around with them, put in different loan amounts, interest rates, down payments, see how it changes that monthly number.
Good idea.
And super important, budget beyond just the house payment for, wants versus needs, but also make sure you keep building an emergency fund. The rule of thumb suggested is maybe 10% to 20% of your monthly income set aside for emergencies.
Okay, that's really practical. So you've done the checkup, you've got a budget range. What's the next big hurdle according to the sources?
Actually navigating the mortgage process itself. And the place to start there is getting pre-approved.
Pre-approved. Okay, what does that actually mean? And is it different from, like, pre-qualification? I hear that term too.
Good question. They sound similar, but they're different. Getting pre-approved means you've actually talked to a lender, maybe a few lenders, early on.
Okay.
You understand the different loan types out there, like those conventional FHA, VA loans we mentioned. You get a sense of their terms, rates, fees, and crucially, they do a preliminary check of your finances, income, assets, debt, credit.
And then they give you
a pre-approval letter. It basically states the maximum loan amount they'd likely lend you based on that initial review. Pre-qualification is much less formal, often just based on what you tell them your income and debts are, without much verification.
So the pre-approval letter is the one that carries more weight when you're actually making offers on houses.
Exactly. It shows sellers you're a serious, financially vetted buyer, which is really helpful, especially if the market's competitive.
Right?
Just be aware that pre-approval process usually involves a hard credit inquiry. It does affect your score slightly for about a year, though the inquiry itself stays on your report for 2 years. And the letter itself is usually only valid for maybe 60 to 90 days.
Okay, so you've got this valuable pre-approval letter. Should you just stick with the lender who gave it to you?
Oh, definitely not. The sources are really clear on this. Shop around, compare quotes from different kinds of lenders.
Like who?
Mortgage companies, big national banks, maybe smaller local banks, credit unions. Look at their reviews online. And don't be shy about asking the loan officer how they're compensated. Sometimes, though not always, a higher commission for them might mean higher costs for you.
Interesting point. Okay, so pre-approved, compared lenders, found a house, made an offer, it got accepted. Woohoo! What happens with the mortgage then?
Okay, now the full mortgage application process really begins. Prepare yourself, because you'll need to provide a lot of detailed paperwork.
Uh-oh. Like what kind of documents are we talking about?
Get ready. W-2s from the last couple of years, recent tax returns, pay stubs, bank statements usually a few months' worth, proof of any other assets, proof of employment, information on all your debts, and if you have other income like alimony or child support, documentation for that too.
Wow.
And expect some back and forth. They'll verify everything and might come back asking for more documents or explanations for certain deposits or withdrawals.
Okay, so that sounds like the loan processing phase. What else is happening then?
Yep, the lender is basically confirming everything you submitted. This is also when they'll order those crucial third-party services. We need to talk more about the home inspection and the appraisal. And they'll start a title search too.
And after processing comes?
Underwriting. Think of the underwriters as the final decision makers. They review absolutely everything in minute detail, your finances, the property info, and especially that appraisal report.
Why the appraisal specifically?
They use the appraisal to make sure the house is actually worth the amount you're borrowing. They need to confirm the value supports the loan. Based on their full review, they'll give the final thumbs up, thumbs down, or maybe a conditional approval.
Conditional approval.
Yeah, meaning they'll approve it if you provide some extra piece of information or clear up some final question. This underwriting stage is also usually when you formally lock in your interest rate.
Okay. Let's circle back quickly to someone with maybe weaker credit. We mentioned FHA and VA loans. Are there any other strategies the sources mentioned for qualifying,
Yeah, they bring up the idea of using a non-occupant cosigner.
like a parent or relative?
Could be, yeah. If someone with stronger credit and income is willing to co-sign on the loan, it can really help you qualify, especially with that DTI ratio we talked about.
How does that work with scores?
Well, for some loan programs, like those backed by Fannie Mae, they might actually look at an average of the median credit scores between you and the cosigner for qualification purposes. But, and this is important, your lowest individual score will likely still be the one used to set your interest rate and any mortgage insurance requirements.
Ah, okay.
And again, having that bigger down payment, still one of the best ways to strengthen your application if your credit's not perfect.
Makes sense. All right, financing is chugging along. Now, for the fun part, actually finding the place. What's the general advice on using a real estate agent?
The sources pretty much universally recommend getting one. They're your advocate, your guide through the whole search and offer process.
And who pays them? I always thought the seller paid the buyer's agent.
Historically, yes, that was usually the case. The seller paid the commission, which was then split between their agent and the buyer's agent. However, the sources do mention some fairly recent rule changes. One source cited August 17th as an effective date that are shaking things up. Now, it seems there's more flexibility, allowing buyers and sellers to actually negotiate who pays the buyer's agent commission and how.
Huh. Interesting. So why is having that agent, whoever pays them, considered so important?
Well, they bring a ton of expertise. They know the local market inside out. Is this price fair? How many other offers might we expect? They help you craft a strong offer, negotiate on your behalf. Plus, they can suggest neighborhoods or even specific streets you might not know about, and sometimes they hear about houses before they officially hit the market.
Okay, so how do you find a good agent? Not just any agent.
Good question. Ask friends, family, colleagues for referrals. That's often a great starting point. Then, check online reviews and agent profiles. And crucially, don't just go with the first one you talk to. Interview at least a few agents.
What should you be asking them in those interviews?
Definitely confirm they're licensed, but more importantly, ask them point blank, will you represent only my interests as the buyer? The sources warn about dual agency, where one agent tries to represent both buyer and seller. That can be a conflict of interest.
Good point.
Ask about their communication style. How often will you hear from them? How reachable are they? Understand their commission structure, especially with those new rules potentially in play. And specifically for you as a buyer, ask how they plan to help you find the right homes and make competitive offers in this particular market.
And read the contract.
Oh, absolutely. Read that buyer representation agreement very carefully before you sign anything.
Okay, agent selected, budget locked. Time to actually look at houses. What's the strategy there?
You really need to go in with a clear list based on your budget and lifestyle. What are your absolute must-haves?
Yeah.
What are the nice-to-haves? And what are the definite deal breakers? Location, size, condition, amenities.
And when you're walking through a potential place, just go with your gut feeling.
Your gut feeling is important, yeah. Does it feel right? But you need to balance that with your practical checklist and, importantly, your agent's knowledge. They might see potential issues you overlook or help you see past cosmetic things that are easily changed.
Is an agent always enough? Or are there times you might need, say, a lawyer involved?
Yeah, the sources definitely bring up lawyers. In some states, a real estate attorney is actually required for the closing process because it's considered a legal transaction.
Wow.
Even where it's optional, the sources often recommend hiring one.
Let's tackle the inspection first. What exactly is it, and why is it considered non-negotiable?
Okay, the home inspection is basically a non-invasive visual checkup of the house's physical condition. Its structure, its major systems, plumbing, electrical, HVAC, roof. It's considered crucial because its whole purpose is to uncover potential problems before you own the place, things you might not see just walking through.
What does something like that typically cost, and how long does it take?
The courses usually estimate around $300 to $500, and the buyer typically pays for it. The inspection itself might take, say, 2 to 4 hours, depending on the house size and complexity. Then you'll get a detailed written report, usually within a day or two.
And you definitely want to weigh out if the inspector finds something terrible, right?
Absolutely. That's why the source is strongly advised, including an inspection contingency in your purchase offer. This clause gives you the legal right to renegotiate or even back out of the deal based on the inspection findings, usually within a specific time frame.
So what are these inspectors actually looking for? It sounds like they check pretty much everything.
They really do. The checklists are extensive. They'll examine the grounds and exterior, looking for foundation issues, proper drainage, the condition of the siding, roof, gutters, chimney, any detached buildings like garages.
Inside?
Inside, they'll check the basement or crawl space for moisture, water damage, look at the sump pump. In the attic, they're looking for stains, structural problems, ventilation, insulation levels, even electrical splices. Bathrooms and kitchens get checked for leaks, water pressure, drainage, toilet stability, exhaust fans, appliances.
Keep going.
Yep. Interior rooms, are the floors and walls level? Any stains or cracks? Do doors and windows operate properly? Lights, outlets, HVAC vents, fireplace conditions, smoke and CO detectors, stairways. They'll look closely at the electrical system, the wiring type, the main panel, how cables are secured. The HVAC system gets checked for operation, filters, any strange smells like gas, rust on the cooling unit, and plumbing visible pipes, the water heater's condition and age, water pressure, hot water temperature. It's thorough.
Wow, okay. What are some of the most common big problems they tend to find?
Things that pop up often include roofing problems, old shingles, leaks, issues with the HVAC system needing repair or replacement, outdated or unsafe electrical wiring, problems like dry rot or mold, especially in damp areas, and sometimes more serious structural damage.
So the inspection's done, you get this big report. What's the next step?
You get the report, yeah. A really good inspector will also walk you through the main findings while you're still at the property, if possible. The key is to understand the difference between minor cosmetic stuff or normal wear and tear versus things that are significant safety hazards or likely to be very expensive to fix.
And if they find those big expensive issues, the seller has to fix them.
Right. Well, not automatically. Legally, the seller usually isn't obligated to make any repairs just because they're in the inspection report. However, those findings give you, the buyer, huge leverage.
Leverage how?
You can use the report to go back to the seller and negotiate. You could ask them to make specific repairs before closing. Or you could ask for a credit, basically, money back at closing so you can handle the repairs yourself. Or you could try to negotiate a lower purchase price overall.
And if they refuse, and the problem's bad enough?
If the problem is significant and you have that inspection contingency in your contract, you usually have the right to walk away from the deal entirely and get your deposit back.
Is the standard home inspection the only one you might need?
Usually it covers the main systems, but the sources mention that depending on the region and the age of the house, a separate termite or pest inspection might be recommended or even required by the lender.
Okay, that makes sense for the inspection. Now, what about the appraisal? How is that different?
Right. The appraisal is a totally separate thing, though sometimes people confuse them. The inspector is focused on the condition of the house, what works, what doesn't, what needs fixing. The appraiser is focused on the value of the house.
Value based on?
Based on its overall condition, its features, its size, and really importantly, what similar homes in that same neighborhood have sold for recently. It's about determining the current market value.
And why does the lender care so much about the appraisal?
Because the house is the collateral for the loan. The lender needs to be sure that if, worst case scenario, you stop making payments, they can sell the house and recoup the loan amount. So they need an independent professional opinion that the house is worth at least what you're borrowing.
Okay, and can you get a contingency for the appraisal too, like the inspection?
Yes, absolutely. An appraisal contingency is also very common in purchase offers. It protects you. If the appraisal comes in lower than the price you agreed to pay, this contingency usually allows you to renegotiate the price with the seller, or, if they won't budge, walk away from the deal without losing your deposit.
Got it. So inspection done, appraisal done, maybe some issues came up. What might happen before you actually get to closing?
This is often where another round of negotiation happens. Based on what the inspection revealed, or if the appraisal came in low, you might go back to the seller to discuss adjusting the price or asking for specific repairs or credits again.
And how successful you are probably depends a lot on the market at that moment, doesn't it?
Oh, totally. Your negotiating power is much stronger if it's a buyer's market. Lots of houses for sale, not many buyers. If it's a hot seller's market, you might have less leverage because the seller knows other buyers might be waiting.
Right. Okay. Assuming you work everything out, negotiations are done, everyone's happy. What's the grand finale?
Closing. This is it. The final step where ownership of the property officially transfers from the seller to you.
Where does this closing ceremony usually happen?
Typically, it takes place at the office of a title company or a real estate attorney, though the sources mention that in some areas, remote or online closings are becoming more common.
And what do you, as the buyer, need to bring to this closing?
You'll need to bring funds for your remaining down payment amount and all those closing costs we mentioned earlier. Usually, this has to be in the form of a certified check or a wire transfer. A personal check won't cut it.
Okay.
You'll also need to show proof that you've obtained homeowner's insurance for the property, starting on the closing date, and of course, bring valid photo identification.
Right, those closing costs. You mentioned they're separate from the down payment. Remind us, how much are we talking, generally, and what kind of fees are included?
Yeah, it's important not to forget these. The sources generally estimate closing costs run anywhere from 2% to 5% of the home's purchase price. So on a $400,000 house, that could be $8,000 to $20,000.
Wow, that's a chunk of change. What's in there?
It's a whole list of things.
Yeah.
The appraisal fee, fees for the title search and title insurance, the home inspection fee maybe, attorney fees if you used one, fees charged by your county or city to record the deed, prepaid property taxes and homeowners insurance premiums, and fees charged by your lender for originating the mortgage, sometimes called points or origination fees.
Okay, that's a lot. Is there some way to see all these costs laid out before you actually show up with your checkbook?
Yes, absolutely. By law, you must receive a document called the closing disclosure at least 3 business days before your scheduled closing. It details all the final costs, loan terms, everything.
You should.
You should review that closing disclosure very carefully. Compare it line by line to the loan estimate you received earlier in the process. Make sure you understand every fee and question anything that looks different or unexpected.
Good advice. So, at the closing, review the disclosure, sign what feels like a mountain of paperwork.
Yep. Sign all the necessary legal documents, including that big one, the mortgage note, your formal promise to repay the loan. Hand over the funds for the down payment balance and closing costs. And then, congratulations, ownership is officially transferred. The seller gives you the keys and the house is yours.
Amazing. Keys in hand.
Yeah.
But the journey isn't quite over yet, is it?
Definitely not. First, you've got the small matter of actually moving all your stuff in. Planning the move itself takes time and effort.
Right.
And a key practical tip: make sure you arrange to have utilities, electricity, water, gas, internet, transferred into your name before closing day so everything's working when you arrive. Call those companies a few weeks ahead.
Good call. And then there are the ongoing costs. It's not just the mortgage payment you budgeted for with PITI, is it?
Not at all. This is where that emergency fund becomes really important again. Homeownership comes with ongoing maintenance costs. Things break. Roofs eventually need replacing, water heaters give out, appliances die. These things aren't usually covered by insurance.
Right.
Plus, even the IMEA, PITI insurance, and the TEAS taxes aren't fixed forever. Your homeowner's insurance premium can go up, and property taxes definitely can.
How much do property taxes usually run? What do the sources say?
They often estimate property taxes are somewhere around 1% to 2% of the home's assessed value each year. But that assessed value can be recalculated by the local government periodically, which can lead to tax increases.
And if you bought into a place with an HOA?
Then you've got those homeowners association fees as another regular monthly or annual expense. The sources mentioned these could range anywhere from maybe $30 a month to $500 or even more, depending on the community and amenities.
So you really have to budget for all these potential fluctuations and surprise repairs long term.
Exactly. It's not just about affording the payment today. It's about affording the total cost of ownership over time.
You know, this whole process we've walked through, carefully saving, budgeting, managing debt, making this enormous purchase, then budgeting for all the ongoing stuff, it feels like it ties into something bigger, doesn't it? Financially speaking.
It absolutely does. And that connects back to that idea of wealth and freedom we mentioned at the start. One of the sources we looked at channels this perspective, kind of like J.L. Collins talks about, where wealth isn't just about having a pile of money. It's about having freedom.
Freedom.
Yeah, there's this sort of parable used about a monk and a minister, where the real wealth was the freedom to live life on your own terms, not being trapped by financial obligations.
Okay, so how does buying a house this huge obligation potentially, fit into that idea of wealth as freedom?
Well, a core principle behind that freedom idea is spending less than you earn, creating a gap, a surplus. The source warns against becoming what it calls a gilded slave, someone who earns a lot but spends it all or more, just keeping up appearances or a certain lifestyle.
And a house is often the biggest lifestyle purchase.
Exactly. It's probably the single biggest purchase that dictates your baseline spending for decades. So the argument goes, choosing a house that comfortably meets your needs, rather than stretching to buy the absolute most house the bank says you can afford, is crucial for maintaining that freedom.
So it's about making the housing decision support rather than hinder the goal of having financial breathing room.
Precisely. It's about ensuring your housing costs allow you to create that surplus, not consume every last dollar. Now, this perspective might view a mortgage as potentially good debt. It's usually tied to an asset that hopefully appreciates, the payments are predictable over time, but the key is still managing it wisely.
Meaning not taking on more debt than necessary.
Right. Don't take the maximum possible loan just because you can. Keep that debt manageable, minimize the burden so you can free up more of your income over time.
And that surplus you keep mentioning, the money saved by living below your means, keeping housing costs reasonable, minimizing other debt. What's the idea there? What do you do with it?
According to this philosophy, that surplus is your engine for building real wealth and freedom. You invest it, simply. Often the recommendation is just low-cost, broad market index funds.
Investing.
Yeah. You take that money you're not spending on an oversized house or excessive debt, and you put it to work for you, ideally automatically, month after month. That's how you build long-term financial independence.
So the choices you make way back at the beginning, how much house to buy, how much debt to take on, directly impact your ability to save, invest, and ultimately achieve that freedom down the road.
Exactly. Your housing decision is really a foundational piece of your entire long-term financial picture.
Wow. Okay, that really brings it all full circle. We've gone from, getting your finances checked initially to finding the right team, securing the loan, getting through those really important inspection and appraisal steps, and finally making it to closing day.
Yeah, and hopefully being well informed about each of those stages helps demystify it all a bit. It takes away some of the stress, helps you anticipate the costs, and avoid nasty surprises.
And like we just talked about, how you manage those housing costs isn't just about paying the mortgage. It's a huge part of your overall financial health and your journey towards building, that life with more financial freedom.
Absolutely. Buying a house is, without a doubt, a massive financial step. But maybe the deeper takeaway here is that achieving genuine financial freedom might depend just as much on mastering the spending side of things, especially on this one huge purchase, as it does on earning more or picking the perfect investment. So the question for you, the listener, is how does the house you're considering, or the one you live in now, fit into your personal long-term vision for freedom?